here in the United States, we all pay taxes, income taxes on everything that we make and that we have. And then when we sell assets that are appreciated, we pay capital gain taxes. But also something that we all get hit with, or some people get hit with, I should say, is if you have a net worth over $15 million per person, $30 million as a married couple, you then have to pay estate taxes. And that estate taxes is 40% above that $15 million if single or $30 million if married. And it's on top of that, there could be specific estate taxes. So oftentimes these are called death taxes because essentially it's the government coming back after money they've already taxed you on and coming back for another bite. But paying estate taxes is optional because you can do appropriate planning through some advanced trust structures that we're going to talk about to mitigate or completely avoid the estate taxes.
Yeah, very true. And if you think about it, if you're 10 million over your exemption, 40% of 10 million is $4 million. I mean, it racks up quickly. And then it also depends because remember, when someone passes away, they get a stepped up basis on capital assets. So that's a big tax advantage. But the value of those things, or think about the value of your business. If your business is worth $100 million, you're going to have a big tax problem. And the IRS wants to get paid in cash in 9 months. So that's a huge challenge because if you had to sell your business, if we had to sell our business in 9 months and everyone knew we had to sell our business in 9 months, what would they do to the price they would offer us, right? They would give us a crappy price because they know we have to sell. So you don't want to put your family in that situation either.
Yep. And so one of the most common ways that you can get around or mitigate these estate taxes is through what's called a dynastic trust or dynasty trust. And the best example here is what Rockefeller did. He created irrevocable trusts, and then those irrevocable trusts held all of the different business interests and all of the different investments and assets. Then each generation was a beneficiary of this trust, but as they say, you own nothing, control everything. And that's the key to an irrevocable trust because we talked about filling up the revocable trust as a bucket. The irrevocable trust is a similar bucket, but that bucket is never going to be subject to estate taxes. So the whole idea is let the money grow and compound within that bucket. It'll pass through generation to generation without ever paying estate taxes, but then future generations can access the money and pull money out. But again, you avoid the estate taxes.
And this takes some foresight and planning ahead. And if I think about Sam Walton, the founder of Walmart, I think it was in the 1950s, he gave away 80% of Walmart, 20% to each of the 4 kids. He kept 20%. And that move alone, after he died, his 4 kids were in the top 10 richest people in the world for many years. Mm-hmm. So think about that. Split it to the 4 remaining, to the 4 survivors, and each one of them is in the top 10 richest people in the world. That was because he had foresight to moving some of the assets, or actually in his case, a majority of the assets, out of the estate long before he passed.
Yep, and specifically, Walton used grantor retained annuity trust, or GRATs, and essentially that vehicle allows you to put assets into an irrevocable trust, and there's a certain IRS benchmark interest rate, and if the assets, which in this case was Walmart stock, grow at a rate that's higher than the IRS benchmark rate, all of that appreciation is removed from your taxable estate. So as a simple example, which is overly simplified, let's say it's $100 million of assets that you put in there, and the IRS benchmark rate is 5%. Well, if the Walmart stock goes up by 15%, 15 minus 5, that's 10% excess on $100 million. That's $10 million that goes into that grantor retained annuity trust free of estate taxes. And then you just keep rinsing and rolling these. It's called rolling GRATs. You keep rolling that money over and over and over again. That's essentially how you saw Walton do this without paying any estate taxes.
Yeah, very smart. Most definitely.
So within the estate taxes, we also, this is where really those 4-letter acronyms come into play. Mm-hmm. We see IDGTs, IDGT. We see SLATs, Spousal Lifetime Access Trust. We see BDITs, if you want to sell the business. We see DAPs, Domestic Asset Protection Trust. So this is where it gets really hairy, and there's a lot of different options here. But what's important that you mentioned is having the foresight, because if you can move a business interest or some sort of appreciating asset into an irrevocable trust out of your taxable estate, it still allows, again, you or your children or other heirs to have access to that money, but you don't own it anymore. And I think a great example here is that we've got a client who recently had a transaction, $70 million. So if you look at it on the surface, ignoring any other assets that they had, if they passed away, there's a $30 million exemption because he's married. So $70 million, let's just say net worth, minus $30 million exemption, $40 million is subject to estate taxes. At 40%, that's $16 million that have to get paid from his estate. But what we did is we got the business valued several years ago for about $6 million. So what we did is we used $6 million out of his $15 million of his exemption amount and put the business into the irrevocable trust. So now all of that growth is outside of his taxable estate and in the irrevocable trust. So he didn't even technically own the bulk of his business. 80% of the business was owned by these irrevocable trusts. But then when he sells it, now all of this growth is outside of the taxable estate, and now we're creating that dynastic trust structure for him.
Yeah, it's so smart. And you know what? This is stuff that you actually need a lot of guidance. And one thing I worry about sometimes with very smart attorneys, they have all these tools, and sometimes they make it too complicated. So sometimes we see entrepreneurs that don't even have a will, right? They haven't done anything. And then we see others that create this maze of complicated trusts and entities that makes sense to the attorney, but is very hard to manage and to keep up with and very expensive for the long run. So you want to find a sweet spot in accomplishing what you want to accomplish, doing it long before it becomes obvious, and yet not overcomplicating your life with a structure that you don't need.